Well, hi traders, here's your Friday update on natural gas. I'm just scanning through the news very briefly. There isn't a lot going on really. There's a couple of websites which are useful. As I always point out, here's a new one for you, tradingeconomics.com, and then there's Business Insider, which I've just added on, and there's Natural Gas World. Just scanning through what's going on in the market, there isn't an awful lot. There are some interesting comments, however, on trading economics. The article here just says the futures are trading slightly higher at almost 2.5 MMBTU, recovering from 2 sessions of losses, and concerns about the financial system easing after the Credit Suisse announced it'll get support from the Central Bank of Switzerland, and still expectations of lower heating demand capped further gains. There's an expectation of further mild weather, etc., and demand is expected to drop as a result to 120 BCFD next week from 120.8, so a very small drop due to mild weather. And meanwhile, gas flows to the LNG export plants have been on track to hit record highs after Freeport LNG's export plant in Texas became operational again. Quite a useful little website, and you can have a look at quite a lot of the energies here as well. If you're interested in trading energy commodities, as a lot of you are, if you're trading gas, you're probably trading oil and other things as well. There's not much on Business Insider that I can see, not much going on. A couple of articles there, and then there's a little bit on Natural Gas World, but nothing really very interesting. There's also not a lot on natural gas intel, just a few articles making a case for and against further strength or weakness in natural gas. So really the main news, although there's not much of it, is that there are milder temperatures expected, that the Freeport terminal is fully operational, and there's a little bit of wobbliness in the market due to bank woes in Silicon Valley and in Switzerland. So having said all that, I think all of that pretty much tells the picture of what we see on the charts. As I said in the last video, the chart pretty much tells the story. We're stuck in this micro range within a mini range within the actual range. So our target remains at $3.50 to 60, 70, somewhere around there. And that's that long-term area where there was a pause in this march downwards, well, waterfall downwards, precipitous drop downwards. And that's where the market paused at this natural support level and bounced around there for a bit. It looked like the market was going to hold there. A lot of people took long positions at this area. We moved around in that range, looking quite hopeful for a while, but we eventually fell through the bottom of that range, trapping a lot of long positions, and I believe a lot of those are still being held, bouncing back up, back testing the underside of that support level, and then falling down into this current range. Now, what's happened in this current range is interesting and remains interesting, is that we fell down to this micro range between $2.66 and $2.38. We were trading in that range for the best part of 2 weeks, and then we had this sort of whipsaw action where we fell down through the bottom of that range, touched $2, burst back up right through the range without pausing, in fact 2 gaps in a row, and then touched $3 before falling back into this micro range where we're trading right now. So really interesting chart pattern, and what seems to be developing is something on the right hand side here that's very similar to what happened on the left hand side. We're trading within this micro range, which is in the center of this mini range, which is in the center of this macro range, I suppose you could call it. So the macro range is between $3.60ish and $1.80 down at the bottom here, perhaps $1.50 maybe even, and then the mini range is from $3 to $2. That's really well defined, slightly below $2, but let's call it $2. And then we have this micro range between $2.66 and $2.38. I want to point out that when I use these numbers, 66 and 38, I don't mean literally those numbers. The market doesn't trade on precise numbers. I'm always interested when analysts quote exact numbers like 266.50 or 236.20. These numbers are just areas, and often the market won't adhere to them to that degree of precision. So bear that in mind when I use these numbers. My strategy going forward has not changed. If you recall, I'm long from $2.10. I hedged 40% of that short at $3, and I added another 5% on at around about $2.55, which leaves me 65% long, 35% short. Both sides of my hedge are currently in profit, and people have asked me, well, why don't you just take profit and close everything for the modest amount of profit that I have? So my long positions are in profit and my short positions are in profit. We're stuck right in the middle right now. The reason I'm holding on is because I still believe we need to move up to about $3.50 in time to come. And that's a natural price magnet, not only technically on the charts, but there's a fair amount of money holding long positions from that level. And there's a fair amount of demand below us at $2 and potentially even more if we dip below $2. I'm able to hold on to both sides of my hedge. My strategy is to wait for a range breakout above either 266 or below 238 If we break and hold above 266, I'm able to take some of my short positions off, which would still be in profit at that time, and therefore rebalance my hedge towards the long side. Conversely, I can do the same if the market breaks down through the bottom of this range, of this micro range. I can take some of the long side of my hedge off and potentially add more short positions as we move lower. What we want is to see a break above, a back test and a hold and a move higher, or a break below and a back test from underneath and a move lower. And it's on those breaks and back tests that I'll be adjusting my hedge ratio in order to maximize the profit for me on these trades. If you're not currently in a natural gas trade and you're itching to get into this exciting but not very volatile market at the moment, you need to wait for a break up above $2.66 towards perhaps this 50-day moving average and a back test down to $2.66, potentially slightly low, maybe a wick type candle, a spike low on the 4-hour or the day chart in order to take a long position, aiming for $3, and then the same here, bearing in mind that there is a danger of another rejection from $3 and a double top forming there. So be very careful when we get to $3. If you're looking to trade short on natural gas, which I know a few people are, then wait for a breakdown below $2.38, a back test from underneath, and maybe again a wick or a spike candle for a move lower down to $2, where once again you might be looking to cover those positions or minimizing your loss in some other way, perhaps by moving your stop loss or reducing your position size or so on. So it's a really, really clear technical picture. We've got this range, the micro range within the mini range within the macro range. We know where the levels are. They're pretty clear. It's gone into the doldrums and the market has not done anything for the last more than a week now. And there's really no action to be taken if you're in a similar position to me. And if you're looking to enter the market, we need a break and a back test either side of 266 or 238. First target's $3 or $2, depending on which direction. If we do get a move down to $2 and potentially lower than $2, those who are looking to buy natural gas will have an excellent opportunity to grab natural gas at really low prices, again potentially for a rally back up to 238, 266, $3, and then eventually $3.50. That would be the best case scenario for those looking to profit from these recent moves in natural gas. I hope you found that useful, and as always, please like the video and consider subscribing to the channel. Thanks so much.